A commodity that was once traded at $140 suddenly becomes so worthless that you couldn't even sell for free. On the 20th of the April, oil prices crossed that $0 mark and went as far as the negative $40. So people got excited since they were experiencing free gas at the gas stations. Some went as far as imagining that they will be paid to buy the oil, which sounds a bit strange. To understand the current crisis, we have to have some clarity on how crude oil prices work in the first. Like any other market, you would assume that the laws of supply and demand drive the price. Oil produced on the one side, such as the Saudi Arabia, Russia, UAE, and others, and the dozens of the major customers on the other sides, such as the US, China, and India. So, if suddenly these countries would no longer want the oil, the prices would decrease, and vice versa, of course. Oil products can also manipulate the price based on how much oil they would supply the market. But there is the problem with the oil market. Sometimes the demand can rise, but the price drops, which doesn't make sense using the law of the economics. And that is because oil prices do not often work with the supply and the demand, but more driven by the happened to the financial market. Yes, those dudes in the Wall Street with the fancy suits quite often have more influence over the oil prices than the oil producers themselves. The industry is really competitive and it's not easy to get into it. You can't simply drill oil under your house and start selling. It's mostly governments or government-controlled companies who are producing crude oil, and risk are high, like really high. Imagine spending millions of the dollars extracting crude oil from your soil, then ship it to your client who is thousands miles away, and then find out that oil prices have dropped. In fact, they dropped so low that selling this oil is just unprofitable or worse. You have to sell it a loss to prevent such things from happening, to be confident that regardless of what happened, the buyer will buy your crude oil at the agreed prices. You make contracts. Let's call it a forward contract where both of you agree to buy and sell the particular assets, in the case crude oil, at the specific price on the specific date. Whether the price of the oil increases or decreases, it doesn't make the seller has the obligations to sell the oil at the agreed price and the buyer to buy at the agreed price. The rich dudes from the Wall Street, but on the other side, the spectrum, there are speculators. There are the rich dudes from the Wall Street who are trying to make money by the speculating on the prices by buying or the selling futures. A futures is a contract pretty much like the forward contract, except it's often not delivered. And it is traded in the market like the stocks and based on what's happening in the oil industry. The price of the futures change. Let's say Mark is trader and wants to speculate on the prices of the current oil by entering into the futures contracts in April with the expectations that the price will be higher by September. The September's crude oil future contracts is trading at $40 right now in the April, and Mark buys the future. The contract is worth $40,000 since the oil is traded in the blocks of the 1,000 barrels. Price 40, quantity 1,000 barrels. Fast forwards few months and September and the end of the contract is approaching. Lucky for Mark, the price of the oil has increased to $52, so the future contract has purchased for $40,000, now worth $52,000. So he sells the contract at that prices and makes $12,000 in profit. But if the price has fallen to the $35, or for example, he would have made the loss of the $5,000. Simple, right? But from April to September, the price on the oil fluctuates, so does the price of the futures, and market can sell at any point. Futures allow investors to use leverage to trade with oil without physically dealing with it. Let's say oil prices are $20 and you expect them to increase the next month, such as the contract worth $20,000. To buy, can use such a future for as little as the $1,000 and leverage the rest. The price goes up to $25 the next month, and you sell the futures for that price, $25,000. If you own your broker $19,000, since you only paid $1,000 for this contract, and you are left with the $1,000 and the $5,000 in profit. Your profit from the crude oil without producing it or buying it. So back in 2001 and 2002, many of these traders speculated that the price of the crude oil would rise, since countries like China and India were growing exponentially. They would need more oil to keep growing, so the demand for oil would increase. Therefore, oil prices keep growing until they reach $140 right before 2008 and crashed together with the rest of the economy, as everyone expected the demand for oil would fall, since there is a financial crisis in the street. And since then, they haven't really grows that much, since renewable energy is getting more and more popular, and a wide range of the other factors. But this doesn't mean the oil gas is getting worse. At least in the next few decades, the oil will still be the major source of the energy, because it is not only used to fuel your car and plane, but it almost everything we use day to day. If that is the case, then how did we end up with the negative oil prices minus 40s? First of all, we had the price war between the Russia and the OPEC countries. OPEC is the oil cartel that consists of the 12 major oil producers, but Russia isn't a part of it. However, in recent years, Russia decided that if it would be better if it would collaborate with OPEC. But then in the March, Russia decided to won't be need OPEC anymore and would better off their own. So the facto leader of the OPEC, Saudi Arabia, decided to punish Russia for the violation of the agreement by following the market with so much oil that prices dropped by half. Traders and speculators were already afraid that oil prices would decrease further, and placed futures contracts at the lower prices. And then the pandemics struck the entire planet. The United States and other major consumers of the crude oil had to go on the lockdown. So with so much oil in the market and with no one buy it, of course the price significantly dropped, especially future contracts, since their price changed daily basis on what's happening in the industry. But what was interesting is what was happening with the futures of the WTI, or West Texas Intermediate. Their last day of the trading crude oil futures contract was the 21st April 2020, which means all the oil traders under this contract is set to be physically delivering next month, which is May. But the country is on the lockdown and the demand of the fuel is below the ground, since there aren't any cars in the streets and the planes are grounded and parked at airports. In other words, the ship full of the oil will be delivered to US, but there is nowhere to store it because United States has seen its oil storage capacity fill up. After all, airlines and other buyers aren't using nearly as much crude oil as they were before the crisis. So if the firms with the ability to store it aren't buying it, still you have to do something with it. You can't simply throw it away or ditch it into the oceans, so the owners of the futures wanted to get rid of these contracts by selling them as soon as possible because, as mentioned before, they have no here to store that oil. And since no one was willing to buy these contracts, the owners of this future paid the buyers who have the capacity to store that oil to take off their hands so that they can exit the markets. So what does that mean? The oil isn't sold for free or for the negative prices. So no one would spend millions of the dollars to extract the oil and then end up selling it for free, but rather only be demand for the futures contracts in the financial markets dropped so significantly that the owners of these futures had to pay the buyers to take off the burden if storing the oil from their shoulders. In fact, the negative prices has scared off the investors so much that the price recovered the next day. The future for the next few months are already higher, reaching even $30 per barrel. Of course, future and forwards are a bit more complicated than we have explored in this video, but in the middle of much mission formations, I wanted to provide some clarity on that exact negative oil prices means. And I apologize that this video isn't on time. The problem with our videos is that they take a lot of the research and are animated by the different persons, so the video can take some time before it ready to be uploaded. Anyways, if you enjoyed this video, I found it very helpful, please give it the thumbs up and let me know in the comments about what do you think about all of this. And of course, if you are new to here, hit the subscribe button and the bell beside. Thanks for watching and until next time.